I love small biz.
Don't worry, this is not an accounting class. We're going to show you a simple way to make sense of your income statement and your balance sheet. Maybe you're already a small business ninja and you know your finances. That's great. You'll still get lots of value from this video. Or if you're just getting started on your business journey, this will give you the ability to hit the ground running. Either way, I guarantee you'll walk away with a new perspective on your business numbers. Let's go. By the way, we're not going to focus on GAAP accounting, generally accepted accounting principles. That's for your accountant or CPA. We're going to talk about common sense, practical ways to plan and use your small business finances. You still definitely need your accountant, and I predict you'll be able to have much better conversations with him or her after this video. Now, I don't like reading info to people, but I'm going to read these next two slides because there's such an important distinction between doing accounting and running a business. Here's what accountants do. They fill out the right forms, the right way, using the right data, submitted by the right date, to the right agencies, to a penny, perfectly in balance. Now, here's what business owners do. We plan and run a profitable business. We optimize operations and finances. We round to the nearest dollar or $100 or to the penny as appropriate for the situation. This is not being sloppy, it's being efficient. Sometimes you need surgical precision, but sometimes it's okay to mark it with chalk and cut it with an axe. Here's a good example, planning for your payroll taxes. Now, I tend to plan my payroll tax to come in around 10% of raw pay, so 10% of salary and wages. Payroll tax in the USA consists of what you see on the screen. FICA is Social Security, and MC stands for Medicare. Those combine for a total of about 7.65%. It varies depending on your situation. Then state and federal unemployment, SUTA and FUTA, come to somewhere around 2 to 3% for a total of about 10%. Your results may vary. Now, you can agonize over this number, but I just don't think it's a good use of time. If you have prior history, look at your last couple of years and use that to guide your plan for the next year. Otherwise, go with 10% and adjust as you get some history behind you and move on. In all aspects of planning and running a business, match the precision to the decision. Here's a question to always be asking. Are we winning? There are many definitions of winning in a small business. Let's start with this. Do you know how a balance sheet works? Have you ever applied for any kind of a loan, either in your personal life or for business? If so, you filled out one of these, a statement of net worth. Here you give the bank the info they want, your assets, including bank accounts, vehicles, and so on, any liabilities like a mortgage or a car loan, and the difference between the assets and liabilities is your net worth. Now, let's change the name of this form to balance sheet. And then let's change the words net worth to equity. Guess what? This is now a business balance sheet, virtually the same as your personal statement of net worth, which you have filled out every time you ever took out a loan. So it turns out you've been a balance sheet ninja all this time and didn't even know it. Here's something important about a balance sheet. It's a snapshot in time. It literally changes every single day that you have any sort of financial transaction in your company. So there's a single date on your balance sheet. Notice that the line items in a business balance sheet will differ from a personal balance sheet. It looks almost identical to the personal net worth document, but with a few changes to the terminology. Now we see something called accounts receivable, which is what your customers owe you if you sell on payment terms, such as net 30 days. You also might carry inventory, and if so, that shows up as an asset. Despite the differences, it's the same basic concept as a statement of net worth. Now let's take a look at something I suspect you're familiar with, the income statement. I personally prefer to call it the P&L for profit and loss, but you can determine your own in-house lingo to use. For the sake of simplicity, we're going to reduce the P&L down to 5 lines. Of course, there are lots of detailed lines in some of those sections, but for today we're keeping it simple. Unlike the balance sheet, the P&L covers a time span, such as a month, quarter, or year. That's because the balance sheet is a static snapshot in time, while the P&L shows activity during the period shown at the top of its page. The top line is sales, also called revenue. You know, for a discipline like accounting, where everything is supposed to be black and white, they sure have lots of things with more than one name. Next, we have cost of goods sold, which I call COGS. This is the direct price you pay for the various products you sell, at your cost. If you sell labor, such as installation, repair, delivery, and so on, you might show your direct labor cost in this area. Your cost for the people doing that direct labor work. If so, you might call your direct labor line cost of sales or direct labor cost or something like that to distinguish it from the cost of physical products. Subtract COGS from sales and you get your gross profit. This is the amount of money left over after paying for your products and labor being sold to cover all your other costs of doing business. Those costs are found in the overhead expense line and include things like rent, office supplies, utilities, insurance, and much more. Including what is very likely your biggest expense of all, and that is all the other compensation you pay to everyone other than those direct labor costs that you may have put under cost of goods sold up above. Finally, you subtract the overhead costs from your gross profit, and you get to the bottom line, profit before tax, or what I simply call PBT. Now, technically, this is not your final bottom line. Below here is an area called Other Income and Expenses. We won't dig into that in this video, but be aware of it. That's where incomes and expenses unrelated to your main day-to-day operations live. It's for things like interest income and gains from asset sales. And since we're talking profit before tax, of course, the dreaded income tax on your profit is also left out at this point. Let's talk about that for just a minute. Tax implications vary wildly from company to company. If you have a pass-through entity like an S-Corp or LLC, the income probably shows up on your personal taxes. And of course, there are a bazillion other factors that impact taxes. So we'll stop at the PBT line and let you and your tax advisor handle everything below that point. Now back to our regularly scheduled program. Here's a quiz. How many of these 5 lines can you and your people have a direct impact on to move the needle? The answer? Only 3. Sales, COGS, and overhead expenses. The other 2 are just math outcomes. So many business experts make things complicated, but it's literally this simple. Plan and manage these 3 areas of your business operation to drive your PBT. We're going to add now one more line to our simplified P&L, compensation. And we're going to break your overhead expenses into 2 line items. So compensation and all other overhead. Why? Because in almost all cases, compensation is your single biggest expense line item. It needs to be front and center. Of course, it's made up of lots of line items, like wages, benefits, payroll taxes, and more. I like to refer to this line as fully loaded comp. In other words, fully loaded compensation. So in this area, you want to capture all of your comp-related items. You might even include the cost of your outside payroll administration company if you use one. Anything and everything payroll goes here. You might have to dig into your accounting software and move line items around to accomplish this. This 6-line P&L is the tool I use for most of my own business planning. Of course, you can tweak it and add line items, but keeping it simple is a great way to start understanding, planning, and analyzing your numbers. Let's add some detail by calculating each line item as a % of sales. Now, please stay with me on this. This will be the biggest takeaway for many folks watching this video. Numbers go up and down. Looking at any number out of context and trying to figure out if that's a good number, a good result, is a shot in the dark. But planning and analyzing your numbers as a % of sales is the great equalizer. So, want to compare your company today to where it was 5 years ago? Compare your percentages. Want to compare your company to other businesses in your industry? Compare your percentages by getting a report on your industry, possibly free online or for a relatively small cost from that industry's trade association. And if you're a member of that association, you'll probably get it for free, and compare your percentages. This is how you can find out if your COGS, labor costs, and other overhead costs are on track with your competitors and with your industry. Use your percentages as a tool for getting better, for continuous improvement. Can you reduce your cost of goods sold by 0.5% this year? Can you grow your sales by X%? Can you maintain your compensation costs at a certain % and make that your ceiling? All sorts of opportunities to use it to monitor how you're doing and to set targets for getting better. Now, let's take everything we've talked about so far and bring it together. We've all heard about fitness challenges. Here's the before picture. Here are the results 12 months later. What happened in between? Work. That's what went on during those 12 months. There's lots of similarity between a physical fitness challenge and a year for your company. Let's make the before picture your starting balance sheet and the after picture your ending balance sheet. The work that was done is represented by your income statement. Now, earlier I said small business owners should constantly be asking, are we winning? I suggest that one of the main ways to answer that question is by comparing the starting and ending balance sheets for a year. If you doubt that statement, compare the two photos on the fitness challenge. So often, many entrepreneurs put so much focus on the P&L. They want to have ever higher revenue, they want to impress their buddies, and maybe even higher profit. Those are worthy goals. That's what we're after. And they can be the road to real, well-rounded business success. But if all the work done by you and your team ends up as a big pile of cash in your car at the end of the year, did the business win? Now, I'm not suggesting that any small business owner shouldn't enjoy the results of his or her hard work. But consider your business the platform you're building for future, greater, and long-term success. Here are some things you might consider doing with the profit. Notice that you're on the list, but so are other things. A single year's P&L and the things you accomplished during that year can get lost in the dustbin of history. So you had a great year, but what if it's followed by 2 or 3 bad ones? All of a sudden, that one year didn't mean so much in the long term. If you had used some of that year's success and invested in your people and in your operation, would you be in a better position now? Would you be better set up for success? And remember, the question is, are we winning? Wouldn't you rather develop and grow your team rather than replace them? I don't know about you, but I hate employee turnover. If you choose to do any sort of employee bonus based on the success and profit of your company, be sure to figure out a good way to educate your people about this fact. You, the owner, don't create a bonus. The team creates the possibility of a bonus by driving great results. In large part, they create their own bonus by being productive and by doing all the other things that lead to good results. Here's one final bit of info. If you don't already know how the P&L and the balance sheet connect, how they talk to each other, here's how it works. The after-tax profit on the P&L gets added to the retained earnings line, which is in the equity section of the balance sheet. So profit that you retain builds a strong balance sheet.
Let me help make you a small biz whiz. I love small biz.